So you've now recently announced a new fund.
Right.
The Opportunity Fund, which is like a later stage fund and has its own manager. I thought it was really interesting that you have a a management fee structure that you only charge fees on deployed capital,
right.
Which, I sort of view management fees as kind of cancerous. I mean, I think, I've heard that the average top tier VC in Silicon Valley makes something like $4 or $5 million a year just for management fees.
Right.
And so when you work at a big firm, which I did, you hear these refrains all the time from big firms, which is like, we got to put more money to work.
Right.
And I noticed as like an angel investor, you would have these situations where the VCs would actually be arguing for a higher valuation in order to put more money in.
Right.
And I would say in any market where a buyer is arguing for a higher price, something is seriously wrong.
Right.
And that kind of, to me, all comes back to management fees.
Right.
And so I thought that was interesting. It looks like you're trying to take a stab at sort of correcting that.
Well, I personally could and probably would like to work for no management fee because I agree with you. It's a little hard because if we had no management fee, we couldn't have somebody to man our front desk.
You could have an operational budget.
Correct.
You could have an operational budget, but they don't need, like, the difference is, like, do you get rich off the management fees, or do you just like operate on the management fees?
Well, so the way we structured the Opportunity Fund, the partners, certainly Brad and myself, are unlikely to ever have any income from the Opportunity Fund. But the whole purpose of the Opportunity Fund was that we've always thought of the venture capital business as a service business, and we're serving entrepreneurs. And in its purest sense, we should be like the lawyer and the CEO coach and the executive recruiter, the people who the entrepreneur goes to for something that they need. And in the case of us, it's capital and occasionally advice and counsel. Mm-hmm. And one of the things that we realized was that as these companies grow and become more valuable, they might not want to go public and they might not want to sell, but the founders might want some liquidity. And this is a big change that's happened in the venture capital business, the secondary market, the founder liquidity thing. And we think that we need to be in a position.
I think it's a positive. By the way, I think it's one of the few cases where financial engineering is a good thing. I don't know.
I think it's great. I think it's great. I've seen it. I've seen founders take money off the table, not in the first year, the second year, maybe not even the third year.
Then they avoid selling the company to a moribund big company and getting.
But not just that. Putting $2 or $3 million in the bank. First of all, their wife feels good, like, oh wow, this thing actually isn't crazy.
Husband,
like you actually could, or husband. Thank you.
Okay.
Very good. And also it allows them to take more risk because now their entire net worth isn't tied up in the company. They can actually make that big bet that they always wanted to make, but maybe couldn't quite pull the trigger on because they had everything riding on the company.
It's where finance is at its best, when you sort of like take some of the risk, like,
right.
Like there's if that founder has all of their risk in that one basket, and you kind of diversify a little bit, and then they step on the gas and
right. And they can become more like us. It's easy for us to think that every company should shoot for the moon because we have a portfolio, right? So what's, the total risk to us of something flaming out is not that large. But for the entrepreneur, the total risk of it flaming out is everything. So if we can allow them to diversify some of their risk and put some money in the bank, then they start to think more like us. So it's good. And we never had the capacity in our early stage funds to do that. So we weren't able to provide that capital for entrepreneurs. So we wanted an opportunistic pool of capital that we could sit on the shelf, and occasionally when we needed to, we could go take a big chunk of money, $15 million or $25 million, and do a transaction.
Do you think those will normally be in companies you funded in the early stage?
It'll mostly be in companies that we are already investors in. And that's also why the management fees are structured differently, because we said to our limited partners, we may not use this money. Like, we may not put it to work. And if we don't find opportunities to put it to work, we won't put it to work.
Yeah.
And so we're not committed to put it to work.
I see. and having a different fund manager?
We brought John in because we wanted to have somebody who had a vested interest in this fund, who didn't have a vested interest in the core funds.
So it couldn't look like you were side trading.
Somebody needed to be the honest broker in the transaction, right?
Otherwise, it was like, hey, how come you put the crappy stuff in this thing?
Or just like taking money from one pocket and putting in the other, right? Like, and charging a carry on it. We didn't want to do that.
Okay, I got it. Because one thing we do at Founder Collective is we have a policy of never following on.
Right.
And that's to avoid any sort of signaling issue.
Right.
But we always feel like we're leaving something on the table. Pro rata rights have value, right?
A lot of value.
I
I think
know.
you got to fix that problem somehow. I don't know what you should do, but you should seriously
But
fix that
we
problem.
actually believe all this stuff I blog about, and I don't know if maybe I'm wrong, but I think the signaling thing's an issue. You know, like what if you're selective, then people are like, well, why are you following on this one?
Well, you could have a pool of capital where you only co-invested where some new lead came on, and you were just doing completely passive and just taking your pro rata share. So
Yeah.
you weren't making any decisions about.
So you have sort of an algorithm or something that like.
Because you're right, those follow-on rights are hugely valuable.
I know. Well, that's why when I saw your thing, I was wondering if that was sort of a way to kind of capture some of that
It is.
without
It is.
maybe all the signaling, because you have an independent person deciding.
It
and
definitely
like,
is.
Yeah.
You know, I think that what I do know is, and I've written this so many times on my blog that you know, people are probably tired of hearing it from me, but you make 30 investments and 10 of them are going to be fantastic, 10 of them are going to be so-so, and 10 of them are going to be bad. And, you know, I mean, maybe it's slightly different than that, but that's generally what it is. And the 10 that are going to be fantastic, you just want to keep, as long as those companies want capital, whether it's so the founders can take some money off the table or because they want to grow or they want to go into international markets, whatever, we want to be the source of that capital. Because it's like it just keeps getting better and better with those companies.
Yeah, interesting. Okay.